All right, good afternoon, everybody. This is Gavin McGuire, Event Trader, being joined by Brett Manning, Chart Trader. Brett, you with us?
I am. How you doing?
I'm doing good. I'm doing good. This will be our last flow and sentiment and flow show for 2019. So, congrats to you on a good year there on your trading on the futures. I know you started off well late last holiday season. And you've done a great job at leading us along the way on all this sentiment and flow data. So, a small congrats to you on 2019. And we are looking forward
Thank
to
you.
doing a little bit of a closeout here. And we're going to take a little bit of a look ahead at 2020 and see what some of the primary issues are going to be there. So, some good stuff on the docket for us. We started off, Brett, discussing last week how it was kind of going to be a two-part show, and because we had a litany of information that we were going to be getting hit with, most notably the Fed, the ECB, and of course the trade talks. So I'm just going to start this off with a recap of that show so we can tie in everything here, and then we'll start breaking into all the different aspects. How does that sound?
That sounds good.
All right, so obviously last week, just for a recap for anybody that didn't get a chance to listen to it, the audio replay is on the site under the Audio X ticker, AUDIOX. Feel free to check that out, and you can combine the two pieces. But, Brett, we talked a little bit about Robo. That was certainly a key ratio that we were looking at, and we're going to take a more in-depth look again today. The high-low piece, which has been pretty popular, just kind of discussing, as you put it, in the exposed nerve potential for downside risk, given everybody crowded into certain trades. We talked about the hedge fund exposure and the whippy action there. Touched upon the skew index, which is of course the black swan index that had been levered up and most likely in front of the trade news that we got. Credit markets remain benign, no issues there. And we talked a little bit about the Fed targeting potential, which of course we'll get into next. And then positioning for inflation, which is something we'll expand upon as we got a little bit of change in some of that data on the sentiment side. And then finally, the ECB push for fiscal policy. So, Brett, am I leaving anything out from last week that you thought was pertinent?
No, I think that was pretty comprehensive.
Okay, so let's go into the three items that came out last week, and we'll touch upon them in chronological order. Starting with the Fed recap, um, we discussed the potential for an implied price targeting from Powell and company, which I think we did get, as Powell
Yes, I think so.
was pretty quick to point out that inflation wasn't a concern, and we're going to take a look at a few inflation data points in a little bit here. But for Brett, what do you, what do you think is the most important item that we need to be watching for in terms of Fed commentary in the coming weeks up until we get into that end of January meeting?
Sure. So I think that as we're going to talk about for the rest of this show, really kind of all threaded throughout every conversation is a particular dynamic that's happening. And that is we are starting to see the Turtle Beach dynamic happen here. The turtles are coming out of their shells. It's moving through more than just the equities market at this point. I would say we're starting to see signs that this healing is starting to show up in the way that companies are acting, the way that banks are acting, the way that households are acting, and the way that investors are acting across the board, and some of the shifts that we're going to talk about with the Fund Managers survey really kind of capture that. So as that happens, the Fed is going to be put into a position where it needs to find whatever language it needs to be able to maintain its position of staying dovish even as the data starts to pick up, and perhaps as their inflation estimations from the data that we got last week start to look like maybe that's a little behind the curve. Maybe it's going to be a little bit quicker to target, and maybe even we start to get the shift toward, okay, let's let it run hot a little bit more explicit with the price targeting theme. I think they're going to be put into that position maybe relatively quickly, or at least there's going to be leading indicator shifts. And I think the next thing we're going to see is a real shift in the nature of the ISM data the next time we get that data point. I think everything so far that we're seeing underneath the surface kind of points to that. And that's a very psychological dynamic. And you and I have talked about quite a bit that there could be this catch-up phase. You might have some upstream supply chain managers that have been suppressing inventory levels because they think the economy is going to weaken. There's all of these risks out there. And so maybe suddenly they're going to need to be more aggressive in terms of stocking up because the consumer never really weakened. And if suddenly the sentiment, the broad economic sentiment, financial sentiment, everything starts to shift, and it shifts in their own minds, they're going to start behaving differently because suddenly they're going to see that they have been putting themselves in a position where they're really going to have to chase that ratio. And when that happens, I think you see a kind of a tonal change in some of these leading indicator data points that put us in a different position. I think we started to see little hints of that kind of building up underneath the surface. And when that happens, how is the Fed going to react? Are they going to immediately go, whoa, this economy is much stronger than we thought. We need to go ahead and start to put the brakes back on. But they've already committed so thoroughly to, really waiting until there's a major inflation problem before they move again, rather than trying to get out in front of it. So I think the way that they handle that regime change in the data is going to be probably the most important. I don't know if that's going to happen before the January meeting, but I feel like that's coming to a head.
Yeah, and I think also from the hawk perspective too, watching Rosengren and George, I know that they've kind of beaten this a little bit to death, so coming from them it probably won't matter. But if we start seeing other people raise red flags around some of the asset pricing that Rosengren and George has,
because that's right, that's the risk that this strategy would be building in dramatically. That fine, you would have an inflation problem, but you have some seriously mispriced assets. And if you keep the punch bowl out there too long in a situation where the economy is doing well, even if there's not inflation, that doesn't mean that there's no problem with that. And they've been really adamant about that. And yeah, I think that there's kind of a division coming.
Yeah, I'll tell you one thing, Brett. I don't know if you got a chance to go through the notes that I had sent you off, but somebody was kind enough to send me over that Albert Edwards Society Generale Global Watch piece, and he had brought up an interesting point about the CPI numbers, in which really the dominant driver has been the shelter component in CPI. But that's expected to slow rapidly in 2020. Do you think this is something that the Fed's kind of watching closely? Because certainly the numbers that we've seen projected from the Fed don't match up with the CPI numbers that we've been seeing. They do, obviously, with the PCE, which is which is a little bit more closely guarded for them. But did you find anything interesting in that aspect from the shelter component?
No, I don't. And I mean, Albert Edwards, I think like he's got a track record that suggests a particular point of view. And I think that there's deflationary risks and there'll be a time for that. But I think that trying to find what trigger factor is going to suddenly cause this terrible, doomsday scenario to be immediately upon us rather than somewhere out in the distant future is probably not the best way to be thinking about how these data points are going to evolve.
Right. I do think one of the primary takeaways from this too, Brett, and we'll dive into this, is the U.S. dollar, which, of course, in the Bank of America Fund Managers survey had it as the most overvalued currency. No surprise there. It's been the primary safe haven for people to go into, but we are starting to see people move out a little bit from safe havens the last couple of weeks. We get a little bit more euphoria into the markets. How do you see the dollar progressing from here? Because obviously that's going to have a big impact on inflation.
Typically, regardless of dispersion in interest rates, typically when you get into a situation where global PMIs are improving and global economic confidence is on the upswing, you get a weaker dollar. Typically, you start to get the crosses dominating. There is really kind of a sense that the dollar, being the dominant reserve currency in the world, is the sort of home base. It's almost like cash in a portfolio manager's account. You start to get portfolio managers holding less cash, and that's sort of more metaphorical than literal in terms of how currencies react. But I think that in a situation where we see improving economic maybe speculative confidence coming into the picture, I would expect to see the dollar underperform in that type of environment, particularly in this case.
Right, which is one more reason why I think you're seeing people over the last couple of weeks really move into these emerging market plays, which have been obviously trailing the U.S. stocks here. So,
and let's not forget what the deficits are doing in the United States. I know we never really focus on this. It's like it's not a real thing, but I mean, at some point, it's a real thing, and it's insane what has happened. Even I can't. I got to find the data point, but just in the last couple of months, the type of ramp in deficits in the United States is just going off through the roof.
yeah, obviously in an attempt to take advantage of some of the lower rates to a certain degree, but it's definitely raising a flag, but certainly not gaining the headlines at this point.
No.
But so we had the Fed there. It was relatively a non-event outside of that price targeting. The ECB, I would also view it as a relative non-event in terms of policy, but certainly Christine Lagarde's first go around there, I thought she did a fantastic job, Brett. You know, she kind of laid out the primary focus of what the ECB is going to be in 2020, and that's a revision of their current policy stances and their mandates, a push for fiscal policy in the region, and of course trying to get everybody on the same page, which, as we know, Draghi had a very difficult time doing that really since 2011. It's been a split between the North and South economies for the most part. So how do you think Madame Lagarde did last week?
I mean, she was a ringer. It seemed like right off the bat.
Yeah, I agree. And by that you mean just an obvious pro stepping into a situation that she could handle.
My comment is, in retrospect, it looks obvious that, of course, we should have expected that to be the case. But, you know, coming in, it's still like, oh, how's this person going to handle this entirely new situation? And you know, I think pretty quickly it was easy to see that she's going to handle it, I think, very well.
Yeah, not too concerned there. But when we take a look at the euro, which I know you had a short on a couple of months ago, you've since left that to the wayside. You have your reasons for the euro, and I would suggest that maybe that they're longer term. Where do you see the euro now? Because again, in that fund manager survey, net 45% said the euro is cheap, which is the cheapest euro valuation in the survey since 2002. It has been marching a little bit higher here. How are you viewing the euro? And do you see that as a trade at all?
So understand that my short earlier this year in the euro, which we got way in the money in, let it come all the way back. But it was really because I had a gigantic target, because I was looking for some very specific thing to evolve into place. And it was really kind of a pre-Lagarde kind of dynamic, which is discounting the possibility for this period. So it's all folded into the cycle risk that we saw come about in, let's say, May, June, July, August. Right, where we started to see, and we'll get into the fund manager survey stuff, but we started to see people speculate, oh, there's like a 40% chance of a global recession, beginning in the next couple months. Like, that's where sentiment was. And in that situation, one of the bets in a pre-fiscal stimulus leaning Europe would be that we start to price in the possibility of a complete breakup of the Eurozone. And that means you start to see string of historic level sovereign defaults come onto the table as possibilities. You see the credit default swaps go through the roof in Portugal and Italy. So that kind of scenario, it doesn't have to happen. The point is the discounting mechanism. It's like the euro, imagine it's a biotech heading into an FDA decision where you've got to price in the possibility that, the drug is completely worthless. Like there's a binary outcome there. The market has to price in, and that's why it is now understood to be, so undervalued, because part of its price function is pricing in its own disappearance, its own existential risk. And that existential risk is there because I'm going to tell you, the next time we have a down cycle, a global economic down cycle, this is all going to happen on some level unless they figure out fiscal union. If you don't figure that out this cycle, you're going to have a lot of people starting to bet on the euro breaking apart completely. Draghi's been very vocal in coming out and saying, the euro is forever, but it needs to be said over and over and over and over and over again because people so easily will believe that that's not true because it fundamentally doesn't seem to be functional. Anytime you get into a down cycle, those rate spreads start to just whip way apart. You just can't see how Italy's interest rates are sustainable in a world where the European Monetary Union is not holding together.
Brett,
so there's going to be people.
Are you implying that Greece shouldn't have negative interest rates?
I'm kind of implying that a little bit, Gav. And imagine if the euro did break apart, where would Greek interest rates go? So, or Italy, Italian interest rates go, or whatever. Like the fact that it's chained together causes distortions relative to the sovereign fiscal situation, and there isn't an international fiscal situation. So until they add that, these distortions are real. There's a real fundamental argument to say that these are just massively mispriced assets when you're talking about the sovereign debt of countries that you pretty much don't start with the letter G. So there's this fundamental conundrum that's been there, and each cycle it's seeped out more. It's gotten closer to the brink, and I think it's sort of like this gyration that's getting wider and wider, and eventually one of those swings hits zero on the downside, and that's just a probabilistic function that's in play, and they need to solve it. They need to solve it with some form of more bold fiscal union, and I think that's why Lagarde is there. But if you start to get that cycle downturn before she gets there, when their only answer is Draghi just making appeals and then leveraging up the bank balance sheet more, then you start to get those credit default swaps start to spike. You start to get that risk priced in more dramatically. So the short was basically on we're going to start to price this in as maybe a toss-up if we start to see more clear evidence that the entire Eurozone is moving into recession. So that was it. And yeah, they managed to squeak through. We saw a pick back up in economic activity. We saw a sort of false downside in the cycle, and we saw some more Germany starting to play along a little bit with the idea that
you've definitely seen a lot more from Germany coming out on that fiscal.
Yeah, and they recognize the risk.
Ministers getting involved there, so
they recognize the risk. You can't play chicken with this.
Yeah. And one of the reasons, if anybody saw that, I'd like Deutsche Bank as a potential swing long here. And we haven't seen money floating back into the European area. Certainly, that single fiscal backdrop is definitely starting to make a little bit of waves, and we saw Lagarde pushing for that. And one of the things that we want to keep it, and the other thing that I think we need to keep in mind here, Brett, and I'll be curious as how this plays into it, and it could play both ways, is Merkel is stepping down in 2021. So, I mean, you could argue that she's been the glue for the entire area for the last 15 years, and that's going to be a pretty big figure stepping down. So one has to hope that Lagarde's able to fill that void and really keep people on. But, Merkel's an elected official. Lagarde is just kind of voted to by the very area where populists would probably be railing against, right?
Yeah, right. So, yeah, right. There is a firewall against populism that may be gradually breaking down.
So it should be pretty interesting to see how that plays out. And also just one of the things that I was looking at, Brett and Quilters, they're talking about the 54 fiscal expansions in 20 different Organization for Economic Cooperation and Development, the OECD countries, of course, since 1970. And generally across the board, it's pushed output higher, but also inflation higher, which kind of leads to our reflation trades that we've been talking about, that bucket. The copper plays gold. That you're in gold right now, right? You're still in the GLD, but you haven't done anything with the futures yet. Are you just looking kind of for a dip to add into that, or is there?
I'm gonna watch it. It's the same way that I got in on the big gold position over the summer that was so good. Just getting in little, small, and wide. I've got a theory I've got an idea about an if-then flow chart, and if it starts to show me the right things, then I will increase the positioning. There's a huge exposure problem in that position, but you never know where it can go to. But we're already at, there's already so much long interest in gold that it's really tough for me to be a part of in any big way. But there is the potential for a regime change here, given the way that it's acted over the last 2 weeks, given the way that we've seen, deflationary risk taken off the table and gold not tank is a signal. And it started to, on intraday swing basis, it started to diverge from being positively correlated with the bond market. If you just look at like GLD versus TLT, they're not that different when you look at a daily chart or a weekly chart in some ways. But if you start to watch the intraday swings, they've started to disconnect a little bit. And we've started to see gold at times move with the rate side. And if that shifts, that's a really, really important dynamic. And maybe it's just in its very early stages, or maybe it's a false signal. It's not really happening. But if we start to shift and see gold correlated with interest rates rather than with bonds, it goes from being a deflationary hedge to being an inflationary hedge. And that's sort of the first signal of going around a corner into what would more typically define the latter stages of an economic cycle, where you have the problem is that you get too much inflationary pressure, that you get too much in the way of, let's call it across the board economic animal spirits. Like, could we be tipping over into that new phase of things? And really the signal there, and possibly the enabling event, is the Fed shifting to possibly this, implicit price targeting structure, where that could be something I could see gold starting to shift into being correlated with interest rates. You see bonds sell off while gold holds up. Eventually then you see that as this sort of deflationary pressure goes away, hopefully over the course of a period, we start to see the exposure drop in gold, but the price of gold not drop, and it sets it up for that next big advance. So I've got a little piece, and it's probably a larger time frame position.
Right, and for the positioning there, I was seeing money moving out of golds and out of most of the
Barely.
risk off. But barely. But
Barely.
We've definitely been seeing most of the risk assets losing a little bit of steam as we get some of this euphoria and, as you said, animal spirits. So with that, let's segue in over to our sentiment piece of the show here. And first thing we'll take a look at is some of the overly pessimistic numbers that we saw, same as last week, Brett, right? The dollar index and that small trader put buying. I don't think either one of them interests you at all anymore, correct? Because you prefer the robo over that small trader put buying.
Yeah, I know. I think that they contradict other data points that are more important and that really show the same thing. So I think this is probably misleading data.
All right. And then on the overly optimistic side, a lot of the same that we saw from last week as well.
It's starting to pile up.
Yeah. The hedge fund exposure was there last week, option spec. Lobo, which I want to get into with you here in a little bit. The AIM, the Asset Investment Manager newsletter rise, and of course the NYSE high and low, which we've been talking about for some time here. Some of the lesser degree ones was the VIX term, the NAAIAM, which is really just a build off of the AIM, and then the bear market survey. So with those in mind, Lobo was the one that was really kind of sticking out to me, Brett, because that was seeing some of the highest numbers I've seen in quite some time. I was running around 1.4, I believe.
Which one?
The Lobo ratio.
Yeah.
And that was some of the highest numbers I've seen from that in a while. I was.
You mean the lowest?
Or well, the
most extreme in
the most extreme.
Direction.
Yeah. So at the lowest level since December 17th, which of course, when we go way back in our calendars there, that was right before the first salvos of the trade wars were fired around Davos.
Well, but let's just say it's also it's this analogy with the tax reform bill, which I think is, you look at the China deal, phase one deal, and the tax reform bill are these big built up geopolitical kind of headline catalyst dramas that then resolve. And they resolve in a way that takes the uncertainty off and leaves you with, what is being marketed as a best case scenario or whatever. I mean, there's that kind of situation. Late 2017, late 2019. They're analogies in terms of the sentiment process.
Right, I completely agree. Moving towards that potential blow off top. Now, for anybody wondering, for that Lobo, this basically means that the largest traders were aggressively buying bullish positions, spending a large amount of their volume on speculative call options,
Or dropping puts.
and relatively little on protective puts.
They could just be de-hedging portfolios.
Right.
So I mean that you get the ratio of the two. If they just start selling all their puts off and not buying more puts, and then they're consistently whatever they're doing with calls. But it could be, like you say, it may be upside hedging with calls. It may be people who are underexposed and needing exposure and using a leveraged instrument to get it done. So either one of those scenarios, but it amounts to the same thing, as you say.
Right, and I think one of the more important things is they've been paying up for these call options too.
And these are big transactions.
Yeah, so the Lobo is anybody over 50 contracts.
Yeah.
So that's the difference between the Lobo and Robo. I think is under 10, right, Brett? Or am I thinking of a small put?
I think it's thinking a small put. I think it's just a division.
Just under 50.
Under or over. But I think a lot of these transactions probably log much bigger than that. But it's a reasonable data set and back testing where you're dealing with the Lobo. You're dealing with mostly professional, mostly institutional option market participation rather than your retail market participant.
And it's at one of, as we were saying, it's at one of its most bullish stances in 20 years. So
yeah,
these are readings going back to 2000. So pretty extreme there on the Lobo side of things. Small put buy.
And now let's just say one thing I want to add in. The last time this happened, we had another month to go before the market topped.
Yeah, exactly. So, which, again, lines up. We got the Fed in January, of course, too. Another round of Davos, although I haven't seen too much on who's going to be presenting there. But just something to keep in mind. I don't think it's anything that you want to go running for the hills by any stretch of the imagination. But I did think that was one of the data points jumping out the most. And you're not seeing as extreme on the small put buying, but I did see something that had moved above 40% for the first time since 2007 in that one particular reading. So, did you see anything on that, Brett?
Which one?
The small put buying reading.
No, but I will just say, generally speaking, in my experience, the Robo top will come more well timed than the Lobo top. So you see the too much exuberance being shown by the larger, more professional traders, and it's sort of a cliche idea, but it really, in my experience, more or less plays out. The Robo is the more important signal. When you start to see the catch-up play, like right now we've got Lobo at an extreme doing, one might say, too many calls, not enough puts, whatever. But Robo is not showing that, and they did a couple weeks ago. It marked the beginning of a shakeout. When we see Robo really move into that same gear, it's time to be a little bit more cautious.
Right. So something that we'll be paying attention to in this show for sure. And I think one of the other great measurements of risk on, Brett, and you talk about that a lot of this could be underpositioned hedge fund managers that are looking to play a little bit of catch up via their options. Another area where you could say that is in JNK, where people are chasing a little bit of yield here. Pulling up the JNK chart on the daily, and we can see that that's starting to make an attempt to break out here. Have you been following this closely at all, Brett?
Yeah, I mean, it's just another sign of what Rosengren and George would be upset with.
Right, exactly. And I just pulled up the weekly on that J&K, and that really just kind of highlights some of the risk taking that we're starting to see come in. Some of the more lower value, a little bit of leveraging going on, looking to chase a little bit of yield going on there too. Certainly, it's a good time to do it because we are with all the news going on with central bank activity and, of course, trade, this is the time to open up and be aggressive. But what that means is all those quick dips that we've been seeing for the last, I guess you could say, 7 years on any sell-offs, that's definitely primed it in place to take part if we saw anything unwind here, be it that trade deal or it's a switch in monetary policy.
Yeah, right, sure. And let me just circle back around just to kind of put all of this conversation in context. I think it's really important to always zoom out every once in a while and just say, well, what's the point of all of this? And the point is, we're seeing right now, and J&K is an example, Lobo's an example, everything we're talking about right now, and the things that we'll get into with the fund manager survey are obvious other examples, but everything that we're talking about right now is the process of people going from thinking, well, tomorrow is going to be worse than yesterday. And that's where we were June, July, August, September, to shifting toward, boy, tomorrow is going to be a lot better than yesterday. And it's that transition, and it doesn't matter how you slice it or which particular thing we're drilling into. We're just lining up one more piece of evidence after another that suggests that people are shifting that perception. That perception sounds like a great thing, but take a look at what the market has done lately. It is the transition from one of those points of view to the other one of those points of view where the lion's share of the gains happen. That doesn't mean that it can't find another gear if we start to see really powerful multiplicative combinatorial dynamic when banks start to feel that way and start expanding credit, or when people and households start to feel that way and start to spend more and they can get more credit, or when businesses start to feel that way. It always seems like businesses are feeling that way in terms of hiring, but perhaps in terms of what they're willing to pay for labor, which helps the households feel that way more, and in terms of how they're going to stack their supply chains. All of this just kind of feeds together. Each one of these aspects makes the other aspects it seem a little bit easier to feel that way about, feel that improving sense of, well, tomorrow is going to be better than yesterday. And it was really the case, if you go back 3 to 4 months, that the predominant sense in terms of investors, in terms of supply chain managers, in terms of households, in terms of, I don't know if it really got to households as much, but certainly in terms of banks across the board, it was this shift of, it may just be likely that tomorrow is going to be worse than yesterday. And we've really shifted into a different gear now. And I think that there's, J&K is a perfect example of it, but so is the Lobo ratio. All of these points are perfect examples of people starting to say tomorrow's going to be better than yesterday. And eventually you get to the point where tomorrow that signal changes back and people are overextended and they've put out too much debt and they've taken on too much asset risk and all sorts of things come into place. And, you know, something shifts things back the other way. And in a sense, the process that we're going through right now is building up a sort of potential energy of vulnerability. So the momentum has shifted, and I think we're going to show other markers of this shift, especially when we start talking about the fund manager survey, because there's some striking elements there. But we're going through this process of that shift, and that's going to basically read through to all of these different data points.
Right. It just points back to kind of what we're doing in August, Brett, when we kept talking about how negative the sentiment was, yet we weren't going anywhere.
Right.
You know, when they're pushing in opposite directions, that usually means that one's going to whip back and eventually just kind of overshoot the two sides, both the actual flow and the sentiment data. And that's when you really want to start getting either cautious or aggressive, I find. But taking a look at, we'll move now into the Flow Show, apart from Bank of America, where they had another $9.1 billion going into bonds and $1.7 billion going out of equities. Now, I'm sure most people are scratching their heads on how did we have a flow out from equities, but it kind of builds upon what we were talking about last week with rebalancing, where we've had a lot of money flow out from equities, but when you look at it on an asset side, or as a percentage of assets, it's really been a minute number. I think it was 1.5% of asset outflows. Is, you know, basically it's a lot of profit taking going on there, it feels like. But we're
maintaining a consistent level of exposure because you inherently lever up as the price of those assets increases in value.
Right.
And the market has been increasing in value.
And if you're curious, what was seen, some inflow and outflow, U.S. large caps seem to be catching a lot of the inflow. Energy tech names, and utilities, which I'm a little surprised at the utility side of things. On the outflow side, healthcare was one of the more notable performers. So I'd keep an eye out on that XLV, which has been really one of the strongest names out there. Now we could see people come in and buy those up pretty quickly, but I thought that was kind of striking to see from the outflow range of things. So Brett, that brings us into one of the more interesting numbers that I was looking at from that flow show, and that was the year-to-date flows, where right now we have 627 billion into cash, 368 billion into credit, 51 billion into government bonds, and 102 billion out of equities.
Mm-hmm.
So that cash inflow, again, that kind of builds to the point of, you got a lot of dry powder there for that blow off top.
Yeah, not a lot of default risk being appreciated.
Right. So, and exactly with the flow into credit and the tight credit
Hence
spreads.
Rosengren and George.
Yes, this would be, if you're wondering where Rosengren and George are looking, this is one of the areas. So, one of the other largest areas of inflows too has been emerging markets, which for the past 7 weeks has seen money flowing into it. So again, keeping an eye out on that. Looking at the EWY, as I noted earlier, from the South Korean side, and then finally the bull and bear indicator is at an 18-month high for this, and that's basically their measure of cash flow going into the sidelines. So I found that interesting, that how much cash has flown in year to date, but that bull and bear indicator has been moving higher here, Brett.
Yeah, but it's still neutral ground.
Still neutral ground, yes, but it's trending, shall we say, and moving again.
And it doesn't have a great track record. It doesn't have a great track record.
Because
I've seen the data on it.
Yeah.
It's a good way to look at, hey, how do flows translate into sentiment on some level. But the way that they have constructed it, when you just look at the hard data of signals, buy and sell signals over time, it's really, I mean, you do better pretty much just indexing buy and hold. So.
Right. And then the last piece of interesting information I saw from that report, BofA is expecting to see a front-loaded 2020. And it would certainly play into what we're talking about here, Brett, right? Where you kind of get that aggressive action early, and the euphoria is out there, the animal spirits are in, and then we start getting a little bit more into the election process.
I would say that's a safe call, but who knows if people are overly positioned for that call? It could become its own contrarian call.
It could be. It could be, but I could see that playing out in terms of the flow of how things are going in. So I just thought that was interesting, because kind of lined up with how I'm seeing things, because I think if we do see that early blow off top and strong set of Q4 earnings and the global economy showing signs of recovering, then we are going to get a bit of a run in the markets here, more so than we have had, and it's going to look really stretched at that point. But
which again is the 2017-2018 analogy kind of situation.
Exactly. And this time, instead of trade, it's going to be uncertainty around the U.S., I would say, because by that going into that second half, we'll know exactly who President Trump's going to be running against, and markets are going to have a little bit better idea. And I think you'd see a lot of profit taking in that scenario, particularly if the global markets are doing well and the U.S. is just simply overpriced. One of those redistributions into international markets, which is another reason why I like the international side of things going into 2020.
Yeah, I agree with that call, but I also think that this is a year where who the candidate is going to be from the left is going to make an enormous difference in how people feel about the importance of the election. The difference between Warren and, let's say, Bloomberg is so striking that it's really going to make a huge difference.
Yeah.
To how people position for that.
And don't be surprised if we end up getting a third party running this time around too. But it's going to be one of the more interesting years for an election, and I'm going to repost my 2016 webinar that I did too. Just it'll give you a rundown of some of the numbers that you generally tend to see in these election years. But moving on, Brett, the fund manager survey, there was a lot of interesting data, as you noted, from this. So we're going to start going through there and kind of talking a little bit about everything. But, basically it confirmed that the bulls are back and buying equities. Some of the numbers jumping out, Brett, and I'll throw them to you and provide your own thoughts. But 29% expect global growth in 2020. Now that probably doesn't seem very large, but this is up from this is up 66 basis points, meaning that it was negative 37 on the flip side only 2 months ago. And I mean, that just really shows, I guess you got to point to the phase one trade deal as being the reason for this big swing in global expectations. But
well, just remember tomorrow's going to be worse than yesterday, and suddenly tomorrow's going to be better than yesterday.
Right,
that's what's happened.
Exactly, but it is a pretty big swing. I think it was the biggest
dramatic
swing in the history of their fund manager survey. So you can just kind of see that big euphoria going on right now. And now 68% say recession is unlikely.
One other dynamic I want to add in really quickly. I think this is the difference between having the cyclical risk be a sort of organic process of people overextended as opposed to the cyclical risk being imposed by a political agenda.
Right.
And then having that removed. Because we didn't have this organic overextension of the cycle. We didn't have massive, crazy build out of inventory to sales ratio, and people just going on a frenzy of non-self-liquidating debt, or we got a brick wall built across the freeway rather than all the cars running out of gas.
Right. The fear was the entire time that there would be a huge supply side crash because of the trade war and a lack of spending.
So it's vulnerable to that 2-month upswing because you remove that brick wall and suddenly the cars are humming down the highway again.
Right, which was always one of our center points too for our argument, Brett, that and why this market could go up. And we'd been tracking the inventory data, like you said, and just never really got to an extreme. The biggest one, of course, was the semis, but that was more of a 2019 story, and we've seen them get through that pretty smoothly. So, it's a big point. It's going to bring us into the CapEx spend in a little bit here, which I think is going to be important. Now, Brett, 68% say recession is unlikely. This was down from it was 33%, meaning that basically two out of every three thought that there was a recession likely in 2020. That's pretty much flipped sides now here, and adding to that, of course, has been some better economic data. Of course, the U.S. jobs number would be one, today's industrial production number. But also one of the things, too, that I noticed, Brett, the OECD Composite Leading Index turned up for the first time in 18 months. So you get a little bit of stronger data supporting that survey reaction. So any thoughts on that outside of what has already been stated, or?
No, I mean, you hit it right on the head.
Right. Also, one thing of interest, we're about to close out the first decade ever without a recession.
That's interesting.
Right.
That's a slow burn, though. One other thing that I've talked about with the cycle is there's a certain amount of firewood you got to burn, and if you burn it really, really slowly, and you stay at inflation of nothing and growth of barely anything for 9 years, it's not really the same thing as a cycle that's blazing hot the whole way. So, you're using up if you imagine the cycle as a certain amount of wood that gets to be burned. This cycle has put in, little chips of wood into a smolder for 9 years.
Yeah, right. And at some point the big log's coming, right?
Well, that's what I'm wondering, right? I mean, that would be that shift of, is gold going to start to correlate with rates instead of bonds? Like, if that's happening, then we just threw all the rest of the wood on the fire. Yeah. And it's going to be blazing hot, and then it's going to be over.
Right. So the big takeaway from that is recession fears obviously have really been pulled back in. Here's one of the more interesting arguments that we're going to see going into Q4 earnings, which we're only about 3-4 weeks away. We're going to get FedEx later tonight and Micron tomorrow, so some big names still to come. But the expectations for global profits accelerated for the next 12 months. This is the first time since August 2018 that we've seen this accelerate, Brett. And the biggest in it's the biggest 2-month jump since May 2009. So
obviously, tomorrow's going to be better than yesterday.
Right, exactly. Obviously, if you're looking at May 2009, you're looking at that March 2009 bounce back. So, that's one of the things to kind of keep an eye out on in terms of where we could get going. Now,
and the correlation with PMIs is important there, too.
Yeah. Now, there's a few numbers, and we'll jump into the PMIs here. There's a lot of numbers that I was going through, Brett, with regards to EPS growth for 2020, and obviously this is going to come into play for valuations. Now, the usual flow is to see EPS numbers moved down just as people try to lower that bar to make it a little bit easier. That's why we see 70% of companies beating earnings every quarter here. But right now, I've seen for an EPS growth model anywhere in the range from 6 to 10% for 2020. Global corporate profit expectations for the Fund Managers survey surged 23% to net 14%, meaning that it was minus 9%. Now, this was the highest level that this has been at since April 2018. And Morgan Stanley, they had a report out on this saying that their earnings model was looking at a consensus forecast at 10%, but they were actually looking at closer to 0%. So there's a lot of different expectations around earnings, and I think that's going to be one of the key stories going in from a valuation perspective for next year. You got any thoughts on any of these numbers coming in here?
I think that multiples are more important than valuations, and I think that in an environment where people start to feel like tomorrow is definitely going to be better than yesterday, multiples have a chance of expanding. So I'm not sure it matters.
All right. Here's one of the more interesting stories that I was looking at from this, Brett, and this kind of works into our inflation environment. So unit labor costs are growing faster than prices in most major economies. The share of the national income going to labor is rising to a tune of about 3 to 1. Mm-hmm. So basically where that comes down to is you got a higher labor share that is more likely to come at the expense of profits. And that was one of Morgan Stanley's key arguments on why they were.
Oh, I see. Okay, right. Yeah.
So, obviously that's good for labor. It's good for the consumer, but it doesn't really help the manufacturing side of things as much there. So I'll be curious to see how this plays out. And whether or not the rising labor costs, which we saw in 2019, really kind of impacts the bottom line for a lot of these companies. If that continues,
it's almost like the impact of inflation on corporate profits. In a way,
basically, yeah. I mean, if you're looking at it,
you're inflating their resource,
and you can kind of see it playing out too in the 2019 story of the consumer versus the manufacturer, right? Where all the services and everything were doing so much better than the manufacturing sector. Wouldn't this necessarily then just lead to them finding different ways to pass it on, and therefore suddenly it becomes consumer price inflation? It very well could be.
Hasn't yet, but that would seem to be, if it becomes a problem for margins such that they can't continue with their model. I mean, let's say it bites in so much that it becomes, it's on the table. Here's what we're up against, this problem.
Right.
The solution is obvious: raise prices,
or
pay
let
people more.
Go.
They'll be able to afford them. There's the cycle of life.
Or let people go.
Let people go. But if there's consistent demand, they're paying people more money. People can afford higher prices. Then the cycle happens suddenly.
Yeah. Well, again, it was a story.
Unless it's about healthcare costs and benefits.
No, this is wages. Purely wages.
This is just straight wages. So, yeah. I mean, you're going to have an environment where people are making more money. Banks are going to give them more credit.
And
You can
there's
afford
labor
higher
costs involved
prices.
there,
Then
so
you get inflation.
yeah.
I don't know. I mean, I'm not, an academic economist, so I'm probably angering somebody out there. But it seems to me that that's the traditional machine of eventually producing the flower of inflation from the stem of labor.
Right. So again, one of the more interesting aspects that we need to keep an eye out on. It's a story that was certainly the 2019 story at the end here, the consumer versus the manufacturer. This is going to continue to go in to 2020, and right now the consumer continues to look strong, and we're going to get into the manufacturing side because a number of items from this fund manager survey I think is really key for that. But keeping on the inflation theme here, Brett, inflation expectations did rise to a 13-month high in the fund managers survey.
Naturally.
Naturally, perhaps because we were just simply so low, there was really no other way for
it had
it to go.
To break. It was a bubble of deflationary expectations that had to burst.
Right, and again, we've been talking about the rise in copper. I don't think it's any surprise that we're seeing this.
The core holding of the leaning wrong portfolio.
Yeah, exactly. There's the JJC up there making a nice move. The CapEx, which we also talked about, which is the miners there. That's starting to edge up as well, too. So really seeing that deflation basket kind of start seeing some early signs of breaking out a long downward trend here as we enter 2020. All right. One of the more interesting aspects here, and I'm hoping I could pull up this chart, the 10-year yield, Brett. We're currently trading right around 189. And the number that I think that people are going to have on the radar, and one that I think will play in at some point this year, is 2.71. And people are wondering, what does that mean? That is the level where I'm not going to be able to pull up the 10-year, unfortunately, here. That is the level.
Do you want the current quote? What are you looking for? I got it?
Yeah.
Oh, you want for people to see. I got you.
For people to see. Yeah.
That makes perfect sense. I'm an idiot.
Yeah, never. But so we're trading at 188.9, 2.71%. That is the number that people are watching for when there could be a little bit of pain in the bond markets that would impact equities. So obviously we're coming up to a pretty key area, this whole 190 to 2 from a psychological perspective, from the 200-day moving average.
We were there in March for people.
Yeah. So we
went back to March levels.
Yeah, and this
was before the recessionary expectations panic in the bond market.
Right, and this is going to be one of the key things that we're going to be looking at. Certainly the Fed will be watching this, but when Brett's talking about that issuance that's expected, this is one area where we need to watch closely, and as per usual. But Brett, you got any thoughts on this rate here? And are you doing anything in bonds in the TLT?
I mean, I'm using it as a signal asset. So, I would think that it would be. I would think interest rates would be a little more volatile on the upside at this point, given everything else we've just talked about. There is this. I mean, it's probably going to happen. There's a little bit of an ascending triangle now. It's such a strange situation to see such an obvious kind of, everything else suggests the bond market should be breaking down sharply right now. I can't understand how it has held up as well as it has, particularly over the last 2 to 3 weeks. And that's something that I'm afraid of when I feel that way, because if it feels so obvious to me, even though the sentiment data doesn't necessarily show, I just feel like it's something that a lot of people must be betting on as well. And so I get a little bit hesitant about taking that, but it's also something where I'm used to kicking myself later and feeling like, well, it was obvious to me. That doesn't necessarily mean it was pervasively obvious. It feels to me like it's surprising to see the 10-year interest rate chart not look a whole lot more like the copper chart. So I'm a little bit dumbfounded that we're not above the 2% level right now, and so that's got me a little hesitant. I would want to be shorting the bond market otherwise under these circumstances, and I don't understand why it hasn't more dramatically started to evolve in that direction at this point. And there's a lot of nuanced factors to the way that the bond market trades, and seasonal factors, and heading into year end, and who knows what. But it really, I would have thought that with the jobs report that we just had, with some of the leading indicator reports we just had, and with the what we got with the so-called phase one trade deal, and what we've seen in the copper market, and what we've seen in this evolution of inflationary expectations and growth expectations, that we haven't seen a more dramatic rise in the long end of the curve. It's not like the Fed is buying 10-year notes, so it really
there's nothing keeping it depressed here.
Of that.
And we'll get into the bond market sell-off here in a little bit, because that did pop into the list of concerns for traders. But some of the other things that we saw, U.S. tech trade still the most crowded, no surprise there. But again, it also kind of plays into the trade impact and the ability for a quick unwind here, as we've seen people quick to sell the tech on negative trade headlines. ISM expectations, they're expected to rise to 53 to 55%, 53 to 55. Obviously an improvement from the current cycles, which are running just around 50. But this is below the cycle highs of February 2011, August 2014, and August 2018. You got any thoughts on that, or do you just kind of view this as just people throwing a dart at the board right now?
I mean, I think that this is basically
tomorrow's going to be better.
I think that there's a general process that's happening, and there's a number of different facets to that process. The number of different windows to look at it, a number of different ways of describing it, but it's the same thing at its heart. And this is another version of that.
Okay. Next up, investors predicting the S&P on average to peak at about 33.22. This is the highest since the question was asked in June 2018. I would bet if we were to take a look at each month this was asked, though, you'd probably see a pretty much a steady 4% expectation increase for 2020. Would you agree with that, Brett?
I think that it's just, I think that this question is going to continue to evolve in the same way that it has based on how things go. And I don't know what the level is going to be, but I think that people will always expect the next sort of round number interval that is just a bit above where we are, a bit above a big sudden pop higher, to be the end of this. And, it's one of the things that has me worried about. It would have me worried if I was in a scale and short situation. Now, I have a trading book and I have an investment book, and I've talked about this a number of times. My investment book is unleveraged and is long the market, and I'm enjoying the process of this market going higher. And I feel like when we see an overwhelming sense of just sentiment data craziness on the upside, I would probably take those assets and move them back into my trading book. And this is a shift that I made in about August of 2016 to divide my assets and move part of it into, I actually gave half of my money to a fund of funds manager outside of myself with a well-established track record of extremely low turnover and extreme diversification, basically so that I'm not sitting there trying to pick the top all the time, because I was aware of the fact that the sentiment situation we came out of in mid-2016 was going to be dangerous and was going to cause me to make a mistake with part of my capital. And I can lever up using the futures market, so I don't need all that capital in every instance. So that's been a staple, and I feel like it's possible that the late 1990s we could have seen this kind of table, and we could have seen all the way up during those next 5 years, this kind of process of people thinking the top is that next 5% threshold higher. And I think it's more a case of kind of like a Daniel Kahneman kind of, game theory behavioral economics sort of effect, rather than containing real information about what the market is doing.
Yeah, and they haven't had the greatest track record either. looking at these predictions, been going through a bunch of them, and that's probably the one biggest takeaway that I've had. But
I think it's just subject to a kind of psychological dynamic at this point.
Yeah, it's funny.
That may be the top, but that this isn't whatever's happening to cause this number.
Well, it's funny. The equity analysts are always upbeat, and the bond analysts are always downbeat. So it's kind of funny to see that dynamic there. So the fund managers survey, their latest look, trade wars topped the biggest concern for traders. It's been that way for pretty much the last year and a half. This was the lowest percentage, though, that voted for trade wars. I think it was 33% since April. Now, two new areas came into play here, Brett. The second largest concern is now the 2020 elections. This came in at 22%. And it just kind of harkens back to the idea that perhaps we see that euphoria, that front-end loaded 2020 play out.
What graphic are you looking at there? What exhibit?
For the level of concerns. Yeah.
Well,
so, hold on a second.
Exhibit number what?
Hold on. I will pull.
Sorry.
Yeah, sorry about that. I was just going off. So, biggest tail risks, page 10.
I've got the biggest tail risk, but you're talking about what the second ranking one is.
Yeah, the outcome of the 2020 elections.
Oh, I gotcha. Right. No. Okay.
Did I say something different?
No. It's my fault.
Okay.
You're doing great.
So
you're doing fantastic, Gavin.
As they're saying, this was new. This wasn't even in the last fund manager survey. Maybe that's where I was throwing things off, Brett. But and then the bond bubble pops, which obviously Brett was just talking about here.
There's another thing that kind of makes me feel a little, again, like I want to shore up the bond market, but if people think, the thing that they're most scared of is the bond market going down, is just one of those, kind of like, oh, is there a serious lack of complacency in the bond market still? Yeah. And I don't understand why, but it definitely works against me feeling comfortable just levering up on the short side in the bond market, even if that makes sense to me.
Right, and obviously it makes sense to 19% of the participants as being the biggest risk. But That's interesting because that's 41% of the surveys putting in the biggest tail risk that wasn't even on in their last November fund managers survey. So
that's very interesting.
I just found that interesting that I guess maybe it's because trade wars just fell so far off. I'm not sure what the exact percentage was, but
it could be if you start to see tomorrow being better than yesterday, then you start to be worried about a spike in interest rates.
Right. And then going on that interest rate theme, monetary policy impotence coming in at 12%. This was down slightly from the last time. Now, some of the things that fell off here a little bit, Brett, is people a little less concerned about the China slowdown.
Which makes sense.
A lot less concerned about the Trump impeachment. I guess as the process goes through, people are well aware that this is going to happen in the Senate. Yeah. So, and then, of course, the trade war declined, too. That was running at about 40% from their November survey, if you're interested, just taking a look at that. But I just thought it was really interesting to see these two items pop in as brand new. I mean, the 2020 election, I guess, is fair as that we get a little bit closer to the primaries and everything like that. But that's certainly rolling into people's ideas a lot more than these trade wars. So it's something that we're going to need to keep in mind for the 2020 headline risk, especially if this phase one deal starts going ahead pretty smoothly. I think that we're both in agreement, Brett, that there's no chance that phase two gets done ahead of the elections.
I'm willing to stake everything on that bet. And I'm willing to lose everything if that's wrong. But I'm willing to stake everything on that bet that we will not see a series of major enforceable structural reforms over the near term in China, no matter what the leverage is.
You're putting the triplets up on this?
Sure. Throw them out there.
They weren't doing any yard work.
Put everything on the table on that one.
So, but anyway.
I'm surprised that we do not see, and I'm going to make a prediction that in the next one of these, we will see, rather than concerns about monetary policy impotence, will be concerns about the possibility of the Fed starting to go back on its word that it's going to be consistently accommodative no matter what happens in the economy.
Yeah.
Because worrying about monetary policy impotence is worrying about them not being able to stimulate enough.
Stimulate it enough.
It's a deflationary concern. And so if we flip to the other side of that spectrum, the other side of that coin, and we start to get concerns of, well, what if we really start to see some pops? What if we see, ISM manufacturing go to 54?
What if we see monetary
really
policy impotence and monetary policy exuberance on the same tail risk?
That would be a sign of the times.
It really could, though, right?
Yeah, you really could.
So, that'd be funny to see. But all right, Brett. So, just taking a look at some of the last numbers here. This goes back to our put call protection. 28% have protection. 62% do not have protection. This is on options and the downside. Recall August 2019 was the highest on record. I think it was running around 40%, right, Brett?
Yeah, no, right.
For that protection. So again, that just kind of builds off of we're
getting rid of our puts.
We're looking at. Yeah,
and I would think that we're getting rid of our bonds, but
not so much. People are.
I thought it was just puts and bonds go out. Yep.
I guess overall.
Puts are going. Look at the Lobo ratio. This is the Lobo ratio here, depicted in FMS form.
Yeah, pretty much. So that's another thing. Obviously, we're going to want to keep a close eye on. And then the final thing that I wanted to touch upon here in the Fund Managers survey, Brett, something that I was seeing on a number of different items, and that's the CapEx spend, which we were talking about before.
Yeah.
46% of participants want companies to spend more money on investments rather than returns. This is the first time since November of 2018. Obviously, we had that big meltdown in December, so share buybacks and dividends seemed a lot more attractive then. But it also points to the idea that we're getting a little bit of a steadier picture out there from the geopolitical front. And I don't think anything's been shown more than in this CapEx. Now, one of the things that
it's one more version of tomorrow's going to be better than yesterday.
Right, exactly.
So you can take advantage of it. You got to capitalize on that.
Right, and one of the things, this harkens back to the earnings, and this was from a Jefferies piece, Brett, where they're saying they're fixated on earnings and think 2020's growth could be closer to double digits. One of the factors is that when CapEx has been weak, like it was in 2019, we get a nice rebound the following year, and that leads to above average earnings growth. When CapEx has been below average, the following year's earnings growth comes in at 11%. Again,
this is feeding on itself, though. This is different elements of a system, playing feedback.
Right.
I mean, you're contributing to a process where what you're doing is impacting the environment for everybody else, and when everybody starts to do that, the environment is substantively improving.
Right, but I think if we're looking at a bull story, the biggest thing that bulls have to hang their hats on, as long as we avoid any real big noise on the trade front, is, and we've been talking about a lot, those inventories down, and this CapEx spending coming. Now, I think
and comps.
And easy comps.
Easy comps.
Maybe not on the
consumer
side of things, but you're going to have people just.
I mean, so much of what was a problem this past summer was comps.
Yeah.
And so you got suddenly a whole different world.
The tax plan that boosted 2018 results.
Yeah.
And now you got the flip side of this.
With a non-fiscal stimulus year.
Yeah, so if bulls are looking to hang their heads on it, this is why we were so fixated, Brett and I, on those inventories.
Comps and chasing.
Yeah. And I mean, it really sets up well. Now, I guess the end question, Brett, is how much is this priced in? That's
none. I don't think that's priced in. I don't.
You see this as another leg higher. You don't think that part of this rally that we've been seeing has been this being priced in?
I think there's another force that's been holding the market up, and we've seen a cyclical swing factor. The swing states of the market election have tipped from being recession is coming to being, wow, tomorrow's going to be better than yesterday. And that swing factor has boosted this market. And I think that it is discounting a PMIs and EPS reacceleration in the cycle. And I think that looks like it's got some footing to it. Now, there is the possibility that all of that is a head fake on a different level. And I think that that's not to be discounted. If we get to the point where we see a lot of exuberance come baking into things early part of next year, and then, we get the uncertainty coming up with the election on the horizon, but we also just get a sense that, maybe this is not really feeding back into that much more credit expansion, because maybe it can't. Maybe people are more leveraged than they seem right now. Then you get a more organic exhaustion of the cycle, and if that starts to flip, then you've got a different ballgame. And I think that we also have a situation where we're going to be instantly back. The second that risk is back on the table, we're instantly back talking about, impotence of our countercyclical measures. Because what do we do in the next recession? And that's going to really impact multiples. I think people, it's this idea, my metaphor with that is when you see trapeze artists in the circus, the tricks that they do when there's a safety net are much more elaborate than the tricks that they do when there's not. So the type of extension you can see in a market like this, if you go back to the 1990s, I mean, the blow-off that we had there, one of the big factors is that was when the largest generation in the history of this country, which is the richest country in the history of the world, was in the period when their consumption, their production, their spending, everything was at its height. The baby boomers were in their 40s, and they had the most disposable income. They were setting up their nest eggs, but it was also because we had the opposite situation. We had a huge safety net. We had higher interest rates. The Fed could cut like crazy. We didn't need to do quantitative easing. All of these sorts of factors. You had the sense underneath that market that if anything went wrong, there was Greenspan there, and he could do a lot. And he could do a lot, and it would matter. And when this market starts to stumble, we're going to be immediately back in a place where we don't understand what tools are going to do anything if we start to get downside feedback in the cycle. So I think that there's the possibility that, if we're getting up onto a bubble of air as we go higher here, short-term dynamics, because I don't think necessarily people playing catch-up in the upstream supply chain is necessarily a long-term structural theme supporting the economy. It's making up ground. But when you make up that ground, I think the easy comps are a big story for next year, but if we start to feed back the other direction, I think the way that reprices risk is going to be quick because we don't have a safety net built in.
Agreed. So, Brett, I think that takes us to a close here. I mean, we talked about trade a ton last week, so do you want to add on anything here? I think we've pretty much made our thoughts known on this, but you got anything to pop in on that? That's probably the one.
For which? For what?
For trade.
I mean, other than, I don't think there's going to be a phase 2 deal.
Yeah.
I think that the point of a deal to be really bullish for a situation would be that it conceded the dynamic that tariffs are bad, and that we would move back to a world where tariffs aren't a stable, consistent part of the picture. Because I think that if you look at something like Dollar Tree, how's Dollar Tree recovering right now? It's not, because there's still 25% tariffs.
Right.
So there's a lot of companies in that situation. There's a lot of people in that situation. A lot of the supply chain, it's not going to be organized. They're just going to pay the tax, and the tax is still there. And that's an element that did not get reduced substantively or taken out of the picture by this so-called phase 1 trade deal. And if this is the only deal we're ever going to see, then this is it. And, you need a new administration to change that dynamic. And I'm not sure that the new administration would be any easier about it. So I think that the situation as it stands, it took the risk of a spiraling escalation temporarily at least off the table. But we can be reminded of that risk at any moment, because let's say we get this signed. The day after it's signed, you could get that tweet. I don't trust this anymore, whatever it is. Like, it's not like this is signed in blood and it's going to last 1,000 years. This could be backtracked instantly. The door is open in both directions for both countries.
Yeah, as soon as they threw that 90-day window, that's when the red flag went up for me.
I mean, it's sort of like a deal because they wanted to sign something, so there'd be something signed. And it doesn't necessarily mean anything. I mean, it can change a week later. So I'm not sure that I see this as a resolution, because it doesn't actually deal with the most important thing, which is either the structural things that aren't going to change about China or the tariffs that we have in place. And both of those things are at loggerheads, and that's not going to go away at any point. And it doesn't take off the table the possibility that everything that we thought was going to happen as of a few weeks ago, we'll think again is going to happen next week. So, I think this is something to hang your hat on. People needed to say we're going to, dance around the fire of something. But I don't know that it necessarily substantively changes the picture that we had. And I think that at some point we're going to be reminded of that again.
Yeah, no, it definitely hasn't gone away completely. All right, Brett, we're getting closer to the close here, so we should probably wrap this up. A little bit longer today, but, obviously we're going to be on a 2-week hiatus with audio down. So, Brett, with that, you want to close this out with a quick wrap-up for 2019 and as we head into 2020?
I mean, yeah, sure. So I think we've covered more than we probably should have here. But, if there's one thing that stands out, it's, we have transitioned. We are in the process of transitioning from yesterday is going to be worse than tomorrow, tomorrow's going to be worse than yesterday, to tomorrow's going to be better than yesterday. And there's a lot of different ways to see that. But that broad transition is something that could have some feedback. It could compound over time as it starts to create, let's say, reverberations in the sort of household, bank, plus company side of things. It's not just an investor, money manager sentiment data point. It's a perception across the entire system, and that's going to impact how companies deal with things. It's going to impact how households behave. It's going to impact how banks behave. So these things then can reverberate back in and cause a more dramatic version of the same thing with investors as those data points start to improve. So we're somewhere along the process of that, but I don't think that we're at the end. But there's going to be moments where we get leaning too far. We need to consolidate. We need to check back. But I don't think that this is, at least right now, in danger of an immediate, unraveling.
Right. All right. So there you have it. So if there's any questions on this, please let us know. We'll certainly be posting a replay of this shortly. So if you missed any of it and wanted to hear us again, by all means, be on the lookout for that under the Audio X ticker. Brett, thanks again, and I look forward to continuing this discussion in 2020.
Awesome, Gav. Thanks.
All right. Talk to you soon.